Hello, everyone. This is Mohammed Akif with Akif CPA. And then today we'll be discussing the Canadian departure return. So, the final tax return after you move from Canada, let's say you already know that you no longer live there, you are not ready to pay the maximum tax, and you're not ready to pay a lot of tax that you've been paying to them. So, what it is that uh, you are going away, moving to a different country, moving to the United States, for any reason, and then the CRA is not happy about this because you are going away. So one more less taxpayer on the Canadian side, and then so we'll be discussing some important forms, some filing deadlines, and also the penalties associated with those forms. There is some other additional information that I'll be sharing with you in terms of what you should be looking out when you are filing the final return, which is the Canadian departure return. And then this is to let CRA know that you no longer reside there. So let's get started. I Before we get started, I do want to discuss with you what we have already discussed in terms of certain other blogs that we have made, video blogs. I mean, so I have discussed the tax consequences of leaving Canada. So I've discussed what happens to your assets. So this is I've done a video on for the Canadian side. I've also done a video on the tax consequences of leaving Canada. The US side, how the US side looks at it. There are various different other topics that I've covered, and that includes your primary residence, your home, your retirement plans. Three common mistakes made by tax preparers when you leave Canada. That happens on the Canadian side and on the US side. How the Canadian departure tax works, and then why is it very important? Why is it very important to do tax planning before you move out of Canada? This can save you a lot of money, especially when you're moving to the United States. This can save you taxes. This can save you headache. This can really save you a lot of trouble in the future. So if you do some planning, if you understand how this is going to work on the U.S. side, this can really be a big time saver too, on top of that taxes. So I've done a lot of those videos. uh, this covers quite a bit of stuff. You check out our blog, our channel, to find other videos. There are some links on below to in the description, and then you can find whatever information you're looking for. So this blog is especially for Canadians who are moving to United States, who are filing their final return or a departure return, letting CRA know that you no longer live in Canada. I'll be sharing some screens with you, going some over some information, forms that are and certain elections that you can make if you do owe money. So let's get started. Let me just pull up the information. Okay. All right. So as I am sharing my screen. So as you can see that there's two main forms that are part of a deposit return. So if you do qualify for those forms, these are form that needs to be filed when you do move outside of Canada. And then this is a very important form because there are some penalties associated with these forms. You do have to understand the filing deadline is always going to be April 30th. If you are a self-employed person, of course, the filing deadline moves to June 15th, but the tax payments are due on April 30th. The forms are due on April 30th. And then the penalties accrue from April 30th. So make sure that you get these forms filed on time. That's the most important thing here because different countries have different deadlines. So US is going to have its own deadline, but for Canadian side, April 30th is the common deadline for a lot of people. So the two main forms that we'll be discussing are T1161, which is to list properties that you where you're reporting if you have properties which are Canadian properties that are more than 25,000 that you even though there might be no departure tax on them. So this could be any Canadian property, any other property which that you own that needs to be reported. It doesn't have to be There doesn't have to be a departure tax associated on that property. It's just a list of assets that needs to be listed down for you to go through this. So let's talk about the list of properties. So this is the form T1161. Uh, so as you can see, I mean, this is if you're leaving Canada, you have more than 25,000. You have to report this form. There are penalties associated with this form, especially when it comes down to filing late. This is $25 per day. I'm just gonna find the place. All right, so the penalty for failing to file is $25 per day. The return is late, up to $2,500. This is, I've seen these penalties quite a bit. There are a lot of accountants on the Canadian side that do miss this form up, and then this is one of the more main forms that needs to be filed. And I cannot stress enough how many times I've seen Canadian accountants miss this property when they are doing a filing return. So there are a lot of Canadians, of course, Canadian tax preparers, chartered accountants, CGAs, you name it. They prepare, Canadian tax returns, but not a lot of Canadians, accountants, or tax preparers understand what happens when you're leaving Canada. This is very important because I want to point this out. Not everybody understands the complexity in terms of reporting, how things should be reported, and then where things should be reported. Whenever you're dealing a accountant or tax preparer on a regular basis, if you're living in Canada, that is okay. I mean, they're good at this, but not everybody is good at when you are departing Canada, when you are leaving Canada. So make sure that you find someone that can help you with the departure return, and also somebody that can help you with the US side too. So a cross-border accountant is the best person to go to. That is my own personal opinion, but of course you can find somebody else as you like. So I wanted to go over this form. So list of properties by immigrant of Canada. Technically, whenever you're leaving, if you have more than 20,000. Again, this is also information that is required. So I do want you to make sure that you understand the requirements of the zone. Of course, we do have exceptions in terms of what should not be reported in this form. Uh, and then all the these exceptions are, of course, cash, pension plans. This is normal. Anything that you own before you. This is for new immigrants. So anything that you own before becoming a Canadian resident or a Canadian person, and then the timeline is 5 years, 16 months. So if you became a Canadian resident, and then but you have been a Canadian resident for less than 60 months, which is 5 years, this is, you don't have to report any foreign other properties that you own in foreign country. Any personal property use also, if it's less than 10,000. So if it's something more than 10,000, you will have to report this on the form. Majority of times, what I've seen is a lot of Canadians miss reporting their rental properties on these forms. So, or stocks. I've seen where this has missed. This is, the description of the property does list down. It must be listed in terms of Canadian or foreign property, and the fair market value of those assets. So make sure that you understand, what is included and what is not included in this form. In some cases, we do report additional information. This could be your main home, depending upon what is happening. There is no deemed disposition happening on this form, so it is just an information form. Sometimes over reporting is not an issue as long as there's no deemed disposition. These are things that needs to be properly accounted for. So plan ahead before you move. Make sure you understand what is being required to be reported on this form, and then this is where needs to be formed. Again, this form has a penalty on it, so make sure this form is part of your tax return. So let's talk about so of course this form is due on April 30th. Just like I said, $25 per day penalty and up to $2,500, the maximum penalty that you have to pay per year. So the other form that I see misses, T1248, which is a deemed disposition form. This disposition form is where you are reporting disposition that is happening for the assets that the CRA will be asking for a tax on. So this is something that is, we don't include the Canadian real property, any other pension plans, cash. Same thing with the 16 months or less. But let's say we have to report stocks, any non-registered accounts, any other trading accounts, crypto accounts, any other precious metals that you might own. These are all the things that needs to be reported on here. You have to report how much you paid for them, in terms of when in the year of acquisition, what was your cost, what was your fair market value. Of course, they adjust your cost basis, and then you get the gain on here. This is, of course, majority of times is capital gains. This form is linked to your capital gains tax. So whatever gains that you do calculate on it, 50% will be taxable. And then depending upon, of course, the new law, which adds more if you're earning a certain amount. So this is not just limited to 50%. So now the law has changed, which includes which taxes more than 50% of the gain. So this form needs to be included on when you are calculating a capital gains deemed disposition on this form. And so this form does requires fair market value of determination. So normally, I mean, if it's something to do with, let's say, for example, stocks, of course we have information on exchanges. We have information in terms of when the stocks are issued to other colleagues in terms of RSU and other stuff. We know what is happening. You can calculate in a case where it is hard to calculate fair market value. Sometimes we are looking for other data uh, on the internet. Sometimes, depending upon what exactly the asset is, the experts in these assets can determine the fair market value. So there is some information available on the internet through exchanges. If not, then if there's something unique, then we have to go to an expert to get the fair market value assessment on the day you leave. What was the value? So make sure that the fair market value is calculated properly, because this is very important. The reason this is very important is because when you are moving to the United States, we do have an election on the U.S. side, a treaty election that we can make, where if the a deemed disposition has happened on the Canadian side, we take the fair market value that you left, the value of the asset, the fair market value on the day you left Canada, we take that as a cost basis on the U.S. side. But in order for that to happen, we got to make sure that we take that election, we make that a TD election, and that's the only way we can make sure that the fair market value is transferred to the U.S. side in terms of cost basis. So understand this form is very important along with T1161, because this determines what happens in the future on the U.S. side too. At the same time, this also determines, if how your tax will be calculated when you're leaving. And then in a case when you don't sell, let's say if you're holding on to this property and then you don't sell it until you move back, we do have an election where you can unwind the dispositions, and this can play a bigger role at that time too. So fair market value is very important. The adjusted cost base is also important. If there is some improvements on it, then the amount number needs to be adjusted. But the fair market value plays a bigger role in terms of the Canadian side and also the US side, because the US is also looking at the same number, right? So make sure that this is as accurate as possible, as good as possible, and in order to calculate the proper tax on the Canadian side as well. You if you do owe taxes of more than 16,500 on the deemed disposition, we do have a election where you can defer taxes, and then that comes with with a security. So in a case where you have more than this, the CRA will ask for security, and the security can be in a different form. It could be another property that you can secure against taxes. If it's something less than this, the CRA agents are really helpful, and they are able to defer your taxes. So once you do defer them, or let's say if you do pay them, you are done on the Canadian side. So that means if you do sell in the future, or you have already paid taxes on it, there's no additional reporting on the assets, because you have done your part for the taxes. So there's no other reporting required once you are done with the departure tax. Make sure that if you do owe more than 16,500, and then if you don't have the money to pay, you do take that election. It is a lengthy process, because there's a special department that goes with it, where they're the one determining how this security is going to work. It takes a little bit longer. I mean, I've seen cases where it goes into 4 to 5 months once you do file the return, and sometimes longer. Again, if you do come back to Canada and you reestablish yourself, we do have a unwinding uh, an election on unwinding the deemed disposition, and then there's more detail to it. I don't want to go more detail right now, because I just want to focus on the filing main forms, the due dates, and make sure the proper information is being reported. There is a box on the T1 that shows that reports how much your tax resident, when you actually stop being a tax resident, and then make sure that you understand that the deductions and the credits will be limited by the number of days that you are in Canada. There's an also a separate information that goes on the T1, which is the reporting of your income when you do become non-resident in the year that you move, and then that is considered worldwide income. So they do take that into account in terms of calculation of the credits and deductions, so where it might be limited. This could be zeroed out depending on what is going on, but that needs to be reported too, because that's how a lot of the things are calculated. So make sure that we report the departure date. Make sure we get the forms T1161, T1243. T1161 has a penalty, so make sure that we understand that this needs to be filed. And then of course we do have payment options that needs to be there. So when looking at this in view of a U.S. return, I want to make sure that the fair market value is reported properly. I want to make sure that the dispositions are happening at this, because the U.S. is also important when it comes to this. A lot of my clients, or sometimes the clients, don't go for a cross border, or person who deals with both sides, so they are not able to connect how the last Canadian return is very important, because it connects to the U.S. first U.S. return. So it plays a bigger role, which a lot of people don't understand, that everybody's thinking it is a different system. We don't have to do this way. We don't have to do that way. But that is not true. Things are connected in many different ways that you might not be able to understand, or might not know about. And then so we make sure that we understand how this works. So I've covered quite a bit of in terms of filing the final return. The three main things is, of course, reporting the date you're leaving, making sure that you do file form T1161 if it's more than 10,000. So these are the value of the property is 25,000, right? So this is not the tax, the departure, the value of the fair market value. uh, it's more than, so it's subjected to departure tax. So that means anything that you own that has a fair market value of more than 25,000, that is subjected to departure tax. That's where the form T1161 will come in. T12143 is of course deemed disposition. This is where your capital gains is connected, and then the capital gains is being reported. We have talked about the departure, the payments. You can defer the payment too, but the payment is due on April 30th. Again, the deferred, it's separate process. It takes a couple of months for you to get it. We'll be also discussing after this video. We'll be also be discussing the U.S. side of the return. The first year, what happens when you move to United States, how the first year is connected, how the Canadian return is connected on the U.S. side too. I've briefly discussed this, but I will go on to filing the first year U.S. return. What options do you have? How does the different forms work? What taxes can be applicable? I will be discussing the federal taxes, also the state taxes, because in the U.S. states are, they don't work the same way, where the CRA is handling both the province and the federal side, except for Quebec. But on the U.S. side, the states have their own forms, and the U.S. the federal have their own forms. So I'll be discussing those. So make sure that you stay. You can subscribe to us. Make sure that if you want to get more information, or if you think you have not done some planning, if you've already moved, reach out to us to info at Akif CPA. We can definitely look at your case, make sure that we can help you simplify the process, make sure we help you stay on one side of the border where you're only paying taxes to one country. I don't want you to be filing from both sides if you don't need to. But there are specific unique situations where this needs to be looked at into more. But I want to simplify the process for you, make cross-border detection as simple as possible for you guys, where you can manage this, you can make decisions, you can understand what is happening, what is going to happen, and then make better decisions for your tax. Thank you.